Hello there. Well, it's that time of year where all the big financial institutions release their predictions for what's going to happen in the following 12 months. And usually at this time of year, I also spend a lot of time explaining why you really should just pretty much ignore what they're saying. That most of those predictions are just not worth the paper that they're written on. They're all a load of rubbish. They'll all be wrong. And that's because in the financial world, as good as your analysis might be, something's likely to happen, something's likely to come out of the woodwork and make a big impact on markets and therefore destroy a lot of those predictions. So it isn't usually worth listening to any of those, and even though they may be entertaining or make good copy, if you like, from time to time. But this time last year, when we looked at a lot of those predictions and proved how poor they'd been, I also, quite stupidly perhaps, decided to make a few of my own. So let's have a look at the predictions that I made this time last year and let's see how I got on. So our predictions were that this year would be more volatile than the previous year. We also predicted that actually the long run returns for equities, the 10-year returns, would be probably worse than they'd been over the previous decade. And the 10-year returns for bonds, however, would probably be better than they'd been over the previous decade. And we also made the call that we thought Bitcoin at some point would probably have a crash. So let's have a look and see how I got on. So we said we thought markets would be volatile. Now that's hardly a revolutionary prediction. Markets are always volatile. And that's kind of the point. Because actually 2024 had actually been a really calm year for markets. And actually in some ways I think people had forgotten that markets are risky. Markets had done so well and been really calm and just gone in one direction. But as we know, a 5% fall in markets happens all the time, at least once a year. A 10% fall in markets happens perhaps once every 30 months on average. And you get 20% falls pretty frequently as well, perhaps every 5 or 6 years. So I think what the point of the prediction was to say, after such a long period with such calm markets, it was more to say just be wary because at some point we will see a downturn in markets. That's what we saw in kind of March or April time. The S&P 500, for example, the main US stock market, fell about 22% peak to trough for us here in the UK after Donald Trump announced all of his trade tariffs. So that was a reminder, if you like, that equities are risky, markets go up, and obviously they also sometimes go down. But I think we also had a reminder this year that usually when they go down, they usually rebound because actually the market's done very, very well since the Liberation Day events. Donald Trump rode back all of those tariffs, markets bounced, and as of the date of the newsletter, the S&P 500, for example, was up about 11% so far in 2025. So despite falling, as I say, 22% from peak to trough, the market's actually had a pretty good year. So, but it's a reminder that volatility is always present, it's always around the corner, something can always come out the woodwork, but also when we do get that volatility, often it's a good time to buy. So our next two predictions were kind of linked. We predicted that over 10 years, the equity returns would be a lot lower than they'd been over the previous 10 years, but that we thought that bond returns would be much higher. Now, obviously, if we made that prediction a year ago, we've still got 9 years to go before we can be proved right or wrong. So, of course, it's far too early to say whether or not that prediction will come true. But we can have a look at how things are going. Now, for the stock market, of course, I said before that the S&P 500 is up about 11% so far this year. And in fact, some stock markets are up even more. So, if you like, that appears to be a bit off track. Stock markets are doing better than we thought they might do. But again, it comes back to the point, why did we say that we thought they could be lower? Because the valuations were high. This time last year, when we were looking at the US stock market, we were saying it was valued at 30 times the earnings of the companies, 30 times price earnings ratio, which is pretty high compared to history. So where are we today? Well, actually, we're at a 29 times price earnings ratio. And what that essentially means is, although the market's gone up, the earnings, the profits of the companies have gone up even more. And we know that company earnings have done very well in the States, mainly because of AI, tech, all those sorts of things that we talked about in various newsletters. So is that going to continue? We don't know, but we do think we should just be slightly wary about stock markets when they are as expensive as they've been. On the flip side, bonds, where the yields are much higher than they were a decade ago, for example, would indicate we should expect some much better returns. A decade ago, the bond yields were very low and we ended up with low returns. Now they're much higher and we should hopefully get some higher returns. And if we look where we have been over the last 12 months, actually gilts have had a pretty good year. They've returned just shy of 5%, and corporate bonds have done more than 6%, so they've done a lot better. And in some ways, actually, the bonds have actually done slightly better, again, than we expected. So if we look at the sort of predictions, I said, a 10-year prediction, we're only 1 year in, so who knows? But so far, we'd say bonds have actually done probably pretty much bang in line with what we thought they might do, whereas equities have actually done quite a lot better. And our final prediction that we made was that Bitcoin at some point would have a crash. And again, the reason for making that prediction is not because we had any sort of particular foresight into what would happen and when it might happen, but just that Bitcoin, like lots of crypto assets, is a very risky asset class. It can do very, very well, and I'm not going to try and predict the returns of that asset class because it just doesn't have those kind of valuation metrics that equities and bonds do. But we know that if you're going to be able to achieve some pretty good returns, if you get the timing right, you've got to be able to stomach the volatility. So this year, from kind of October to the early part of December, Bitcoin actually fell about 27%. So that's quite a big fall. But to be fair, if we put that in context, 3 times in the past, Bitcoin has fallen by more than 77%. So again, just really a reminder that risk and return are correlated. If you're going to get those excellent returns from Bitcoin, if you're lucky, then you have to be able to stomach the ups and downs as well. So I started by saying that predictions aren't generally worth the paper they're written on, and then of course we went along ahead and made our own predictions. But the point of this isn't to try and say that we can predict the future, because we can't, but we can say that past behaviour can often be a guide to future behaviour, and it's a good reminder of some of the core investment principles. So for example, as I mentioned before, risk and return are correlated. You can't get good returns without being able to stomach some of those volatilities. However, we think the best defence against that is diversification. Have lots of different assets that all act differently, and hopefully even if you get one of them wrong and that underperforms, one of the other ones will outperform. We think valuation is important. If you buy things when they're cheap, or you hold more of things when they're cheap and less of them when they're expensive, then you give yourself a better chance of getting those sort of steady returns. But equally important is also rebalancing. So when you do see periods of volatility, when markets do fall, then sometimes it's good to rebalance the portfolio, take some money out of another asset class that's held up well and buy into the asset class that's fallen. So, as I say, when you see all those predictions from those big banks and things saying what they think the FTSE or the S&P is going to be worth this time next year, just remember, they don't have a clue. It will be based on some very sound intellectual analysis, but of course they've got no crystal ball like the rest of us. So thank you to everyone for watching this. We hope you have a fantastic Christmas, and we'll see you again next year. Thanks a lot.